Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
Good morning.
It's certainly been a week of, well, head-spinning market action, hasn't it?
It really has. Quite a roller coaster.
Yeah, and you're trying to stay on top of the big financial stories without feeling like you need a PhD in economics just to, figure out what's going on.
That's exactly right.
That's where we come in.
Exactly. The sheer volume of news and the rapid shifts we're seeing can be pretty overwhelming.
Mm-hmm.
So our goal today is to take a deep dive into some of the most significant recent financial headlines. We're really focusing on the intertwined issues of trade, tariffs, and, of course, the resulting market reactions.
Okay.
We've tried to sift through the noise so you don't have to, bringing you the crucial insights.
And we've got a solid set of sources to work with this week, mainly looking at MarketWatch and Bloomberg articles.
Right. Good sources.
These cover everything from the nitty-gritty of company-specific news to broader trends in market analysis and the informed opinions of various experts.
So quite a range.
Yeah. Our mission is to unpack it all for you, extract those key nuggets of knowledge, and hopefully shed some light on what it all means for the bigger picture.
Sounds good. Where do we start?
Okay, let's dive right in, starting with a MarketWatch piece. It initially sounded like good news for some major players in tech, but, well, as usual, there are layers to peel back.
You must be referring to the MarketWatch article. Apple, NVIDIA get tariff exemptions for now, but massive uncertainty lies ahead.
That's the one.
Yeah, the headline itself kind of tells the story, doesn't it? Temporary relief, but ongoing concerns.
Right.
So the Trump administration announced it would be granting tariff exemptions on a range of consumer electronics imported from China.
Right. And this list includes some pretty significant items: smartphones, laptops, those crucial integrated circuits.
Yeah, the chips.
And even the very equipment used in semiconductor manufacturing.
And importantly, these exemptions were from those potentially hefty reciprocal tariffs on China, which had been floated at, what was it, a staggering 145%.
Yeah, exactly. So a big deal. And the market certainly took notice. Apple stock jumped over 4%.
Yeah, 4.06%, I think.
And NVIDIA saw a rise of more than 3%, 3.12%.
Right.
You'd think that would signal smooth sailing for these giants, wouldn't you?
Well, that was the initial feeling, sure. But the MarketWatch article quickly drills down to the fact that this reprieve might just be fleeting.
Okay.
It doesn't seem to represent a fundamental shift in trade policy. Commerce Secretary Howard Lutnick, he was on ABC News, clarified that while these particular categories got exemptions for now, the administration is still committed to implementing more targeted tariffs specifically aimed at the semiconductor industry.
Okay.
The stated goal, as Lutnick put it, is to, revitalize domestic chip production.
Which really throws a wrench in the works for the longer-term outlook, doesn't it? Especially for these tech companies.
Absolutely.
It's like getting a pass on one exam, but knowing there's a much bigger, tougher one coming up.
That's a good analogy. And to further muddy the waters, the article mentions a social media post from President Trump himself.
Oh, right.
That didn't exactly clarify the situation, leaving this kind of lingering sense of ambiguity as the week closed.
So much for clear market signals.
Indeed, that uncertainty is a crucial point for listeners to take away. For a company like Apple, with its vast manufacturing in China,
Huge.
The initial prospect of those broad tariffs had raised significant alarm bells. Analysts were worried about Apple needing to either hike iPhone prices,
Which consumers wouldn't like.
exactly, dampening demand, or absorb those tariff costs themselves, which hits their margins directly. And the fact that Apple stock had already taken, an 11% hit between April 2nd and that Friday close,
Wow.
that really underscores how severe those concerns were.
It's also worth remembering Apple did get some tariff relief during Trump's first term, didn't they?
They did, yes. So they've navigated these waters before, to some extent.
But this feels different, maybe. Especially with this explicit focus on semiconductors, which are just so vital to everything tech.
It does feel more targeted this time. And that's where the analysis from Bernstein's Stacy Rasgon, mentioned in the article, provides an interesting perspective.
Oh, yeah. What's his take?
He suggests that these exemptions, while they look like relief, could actually be a strategic opening for renewed negotiations with China.
An opening. How so?
Well, his reasoning is, by offering this temporary concession, Trump might be trying to bring China back to the table for more meaningful talks, especially after previous actions had, seemingly cornered them.
So less about easing tensions and more a tactical move.
Potentially, yeah. Part of a larger geopolitical and economic game. What do you make of that? Does that change how we should view these exemptions?
It definitely adds a layer of complexity, doesn't it? It's not just tariffs up or down. It's about the strategic chess game being played.
Exactly, with tariffs as a key piece.
Okay, so let's zoom out from Apple and NVIDIA and think about the wider market impact. The second MarketWatch article we looked at.
Right, the one titled as Sell America Trade Rattles Washington and Wall Street.
Here's what could bring U.S. markets back from the brink.
Yeah.
It delves into this broader perspective, introducing this kind of concerning Sell America Inc. trade concept.
Yeah, let's unpack that.
What does it actually mean?
Well, at its core, the Sell America Inc. trade, as highlighted in that ING Strategists report cited by MarketWatch,
Okay.
it describes a situation where we're seeing the U.S. dollar weakening and Treasury yields rising at the same time.
Which is unusual, right? They don't always move together like that.
Not typically in this way, no. And they're moving together like this suggests a potential drop in the attractiveness of the U.S. for foreign investment.
Right. Makes sense.
I mean, think about it. If the dollar's worth less and it costs the U.S. government more to borrow, why would international investors want to park their money here?
And President Trump himself even acknowledged the tricky situation in the bond market, didn't he? After announcing that 90-day pause on tariff hikes for both countries.
He did, hinting that maybe the bond market's reaction played some role in his decision to, ease off the pressure temporarily.
So that raises a big question for listeners. Are we seeing major holders of U.S. debt, like Japan and China, maybe rethinking their positions?
Potentially reducing their holdings of U.S. treasuries.
Yeah.
That's certainly been a hot topic, lots of speculation. Some analysts suggesting they might be pausing purchases or even actively selling U.S. government debt.
But is there evidence?
Well, the MarketWatch article points out that concrete proof of large-scale selling hasn't really shown up yet.
Okay.
In fact, recent Treasury auctions, the 10-year and 30-year bonds, actually saw decent demand. Buyers stepped in.
So the panic isn't fully justified yet.
Maybe not fully. The underlying concern about a shift in global demand for U.S. debt is still there, but we haven't seen it hit the market hard just yet.
Right. But it just shows how these trade policies can ripple out in unexpected ways, affecting capital flows, investor sentiment.
Absolutely, it's all connected.
So while some see these signals as worrying, others, like Jason Brown from Alexis Investment Partners mentioned in the article.
Right, he sees opportunity.
Exactly. He views these market dips as potential buying opportunities. He's apparently been adding long-duration treasuries and thinks stocks like NVIDIA and other Magnificent Seven members look attractive now.
The classic buy low strategy during uncertainty.
Yeah. What's your take on that kind of contrarian approach right now? Seems risky.
Well, Brown's perspective definitely highlights that idea that big market shakeups can create opportunities, right? For investors with a longer view, maybe a higher risk tolerance.
Sure.
He's basically betting that these current worries about trade will eventually ease off, letting quality assets recover.
It really makes you think about your own investment horizon and risk appetite, doesn't it?
It does. Are you looking to jump on dips or play it safer when things are this uncertain?
And then there's this idea of peak uncertainty. David Lefkowitz at UBS, he suggests Trump's tariff pause might be the first step towards restoring confidence.
Implying maybe we've hit the worst of the uncertainty.
Kind of, yeah. And interestingly, the article mentions a Bloomberg index that tracks trade policy uncertainty.
Oh, right.
And it actually showed a slight decline recently. Could that be a sign things are calming down a bit?
It's certainly possible. Lefkowitz's view is that by showing some response to market concerns, the administration might have eased some of the worst fears, like a looming recession, and that dip in the uncertainty index offers some data to support that optimistic view.
But there's always a but.
There usually is. As the MarketWatch article cautions, it's just one indicator. There are still plenty of other risks out there.
Absolutely. Like, we're still early in corporate earnings season.
Right.
And this lack of real clarity on trade could easily lead more companies to cut their profit forecasts, like Delta Airlines did.
And we know what happens then. That Bank of America strategist note mentioned. Companies ditching guidance tend to see their stocks underperform.
Exactly. So even with this temporary tariff pause, earnings reports could stir things up again. What are you watching for in those reports, specifically related to trade?
I'll be looking closely at any commentary on supply chains, input costs, can they pass costs to consumers?
Right.
Any big downward revisions citing trade uncertainty would be a red flag. It could signal a broader economic hit that maybe the recent market rebound is ignoring.
Raises questions about the underlying strength of the economy facing these trade issues.
Definitely.
But look, we did see those big market rebounds after the pause announcement. The Dow, NASDAQ, S&P 500 all had strong weekly gains.
Good gains, yeah.
And Treasury yields jumped up too. The 10-year and 30-year saw their biggest weekly increases in a while. Even the euro got stronger against the dollar.
It was a pretty dramatic week of reversals across many assets.
Okay, so let's pivot now, look across the globe. How did Asian markets react? We've got a CNBC article for this. Asian markets live, stocks rise.
Right. This CNBC piece details a pretty widespread positive reaction across most Asian stock markets.
Okay.
This was in response to that U.S. announcement pausing planned tariff hikes for everyone except China.
Key exception.
Very key. So leading the gains was Japan's Nikkei 225 and the Topix Index substantial increases, over 9% and 8% respectively.
Wow, big jumps.
Huge. South Korea's Kospi and Kosdaq also surged, both up around 6%. Australia's S&P SX 200 saw a healthy jump too, over 4.5%.
But mainland China and Hong Kong,
Yeah.
more moderate gains, like 1–2%.
Exactly. The CSI 300 and Hang Seng were much more muted, which, as you said, makes sense.
Yeah, because the U.S. actually increased tariffs on China to 125%, and China retaliated with 84% on U.S. goods.
Right. So for China, the immediate outlook is way more uncertain compared to other Asian economies.
That's a critical distinction. While the global pause helped elsewhere, the U.S.-China conflict keeps escalating.
Precisely. Wenli Zhang from T. Rowe Price had some insightful comments in the article. He called the increased tariffs effectively prohibitive.
Prohibitive, strong word.
Yeah, likely leading to significant trade disruptions between the U.S. and China. But he also pointed out the direct hit to China's overall GDP might be less severe than you'd think.
Really? How so?
He estimated a direct hit around 2.7%, maybe 3.5% total, including indirect effects like trade diversion.
Okay.
And interestingly, he noted that companies on the MSCI China Index actually have surprisingly low direct revenue exposure to the U.S., only about 1%.
Only 1%? How's that possible?
Apparently, a lot of their exports go to multinationals or Taiwanese firms for more processing first.
Direct routes.
Yeah.
Still, Zhang said even with low direct exposure, Chinese firms could suffer from secondary impacts, right? Like a weaker global economy.
For sure. And indeed, Goldman Sachs actually cut its forecast for China's 2025 GDP growth down to 4.0% from 4.5%.
Directly citing the U.S. tariffs.
Yep. Citing the tariffs and expecting more policy easing from Beijing in response. They estimate a pretty significant 2.2 percentage point dent in China's real GDP from the higher U.S. tariff rate.
That is substantial.
It is. And the ripples go beyond stocks. The CNBC article mentioned Japanese government bond yields rising after the U.S. pause.
Meaning investors moving from safe bonds to stocks.
Likely, yeah. A shift in sentiment back towards riskier, potentially higher growth assets.
And meanwhile, China's 84% retaliatory tariffs on U.S. goods had already kicked in.
They had. Oh, and the article also mentioned oil prices falling.
Why?
Attributed to these simmering U.S.-China trade tensions, suggesting worries about future demand.
Okay, but it wasn't all gloom in Asia, right?
Yeah.
Tech stocks surged.
Definitely. We saw big jumps in several Asian tech companies.
Yeah.
LaserTech, Advantest, SK Hynix, Samsung Electronics.
All benefiting from that U.S. pause on some tech tariffs.
It seems so. That temporary relief in the U.S. had a positive knock-on effect in Asia, highlighting just how interconnected the global tech supply chain is. And even Ray Dalio reportedly urged Trump to use this pause to try and make a deal with China.
Interesting. That surge in tech stocks really underscores the global nature of electronics manufacturing.
Absolutely. Even a temporary break from tariffs gives them breathing room. We also saw Australian mining stocks jump.
Because of gold prices.
Exactly. Gold ticked up after the initial U.S. tariff hikes on China, playing its traditional safe haven role. Spot gold even briefly broke $3,100.
And SK Hynix, you mentioned them, their stock jumped over 10%. Was that just tariffs?
Partly tariffs, likely, but also boosted by a report that SK Hynix had overtaken Samsung in the DRAM market, especially in HBM for AI servers.
So company-specific news too.
Right, a mix of factors there.
What about China's internal economy? The article mentioned something.
Yeah, it noted consumer prices fell for a second month and producer price deflation deepened. Signs of ongoing challenges within China, separate from the direct trade impact. Meanwhile, Singapore and other ASEAN markets saw gains, mirroring that positive sentiment post-US pause. But the Chinese onshore yuan kept weakening.
reflecting those underlying U.S.-China tensions.
Exactly. And finally, the article highlighted a huge surge in Taiwanese stocks up over 9%.
Wow. And trading volume spiked too.
To a 16-year high for the Taiwan dollar. Seems driven by tech demand, likely companies front-loading purchases before potential future tariffs hit Taiwanese electronics.
So a market very aware of the risks, trying to get ahead of potential volatility.
Definitely paints that picture.
Okay, let's turn to some expert analysis now. What might the future hold? We're looking at Citigroup, Morgan Stanley, Bloomberg Insights here.
Right. So interestingly, despite that recent market sell-off we talked about, Citigroup actually downgraded U.S. stocks to neutral.
Downgraded.
Uh,
Even after the dip. Why?
Their reasoning, according to that MarketWatch piece, even after the sell-off, U.S. stocks are still too pricey, is that valuations are still too high. And they expect more downward earnings revisions, with trade tensions and potential tariffs reinforcing their call to diversify away from the U.S.
Diversify away. They used that phrase cracks in U.S. exceptionalism, didn't they?
They did, suggesting maybe a more lasting shift in how attractive U.S. equities are relative to others.
What's particularly interesting in Citi's analysis is they feel the U.S. rally might have already priced out the most bearish outcomes,
Right.
while other markets like Japan, emerging markets, Europe, still have more pessimism baked in, giving them more cushion.
Potentially, yeah. A greater cushion against negative surprises. They also point to investors moving away from other U.S. assets, the weaker dollar. Rising Treasury yields suggesting a broader capital shift away from U.S. equities might be happening.
But wait, didn't Citi upgrade the tech sector? Seems contradictory.
It does seem a bit contradictory, but their logic is tech might see some near-term positive momentum from the tariff pause and the strong cash flow of some Mag 7 firms.
Okay, so a short-term tactical call on tech.
But their medium-term view is still dominated by those cracks in U.S. exceptionalism. And conversely, they upgraded Japanese equities to overweight,
Why Japan?
citing underperformance earlier this year and more pessimistic earnings expectations already priced in, making them potentially more resilient now.
Really highlights this potential big reshuffle in global investments as people navigate trade risks.
It absolutely does. And adding to the caution, both Morgan Stanley and Citigroup have reportedly cut their 2025 earnings estimates for S&P 500 companies,
Directly blaming tariff threats.
directly attributing the cuts to tariff threats and
Yeah.
curbing profit growth. Yeah. Scott Kronert at Citi lowered his S&P 500 target, and Mike Wilson at Morgan Stanley cut his EPS forecast.
So the big banks are getting more cautious on future profits.
They are. And while Morgan Stanley's Mike Wilson says the 90-day pause lessens the immediate recession risk, he stresses that significant uncertainty persists. It's like, we got a temporary stay, but the fundamental trade issues aren't solved and still cast a shadow.
Right. And Goldman Sachs saw potential for large surpluses in the global oil market because the trade war could hit demand.
Yeah, which fits with that earlier point about falling oil prices.
Benjamin Mellman from Edmund de Rothschild Asset Management basically echoed that sentiment, right?
Yeah,
Lack of visibility, likely continued volatility.
he did. And that Bloomberg article, Stock Market's Extreme Moves Portend Lasting Trouble for Traders, adds another layer of caution.
How so?
It points out that historically, the S&P 500's best single days have often been followed by weaker returns short to medium term.
Suggesting this recent rally might just be a temporary head fake.
That's the concern, yeah. Not necessarily the start of a sustained climb.
And the article notes many of those huge single-day gains happened during major economic crises.
Yeah, like the pandemic, 2008, even the Great Depression. Sobering context.
It really raises concern that these wild swings might signal underlying instability, not recovery.
Exactly. And analysts at Barclays and JPMorgan Chase basically said it's incredibly hard to predict the market's path right now with all this trade policy uncertainty.
Adding another angle, Frank Munkum at Buffalo Bayou Commodities called the recent rally the mother of all short squeezes.
Implying it wasn't fundamentals driving it, but technical factors, short sellers forced to buy back stocks.
Right. And Stuart Kaiser at Citigroup suggested a potential buyer strike soon until risks are more fully priced in.
Yeah, and Michael Hartnett at Bank of America is apparently telling investors to sell rallies, at least until the Fed steps in or the U.S.-China trade war cools down.
So, despite the pause, the expert consensus seems pretty cautious still.
Overwhelmingly so. Recognition of significant ongoing uncertainty. Frank Munkum summed it up well. Another 3 months of dark macro clouds.
And that earlier point about Taiwan dollar volume surging.
Right. Reinforces the unease. Companies trying to get ahead of potential future tariffs. Analysts like Mingzi Wu at StoneX and Zhu Wang at BNP Paribas expect the Taiwan dollar to stay strong, partly because of this front-loading.
Even Taiwan's state banks were intervening, trying to absorb the inflows.
Reportedly, yes. Buying U.S. dollars to manage the currency pressure.
Okay, this all leads to a really crucial question for our listeners. With all this complexity and uncertainty, what practical steps can people take?
Yeah, how do you protect yourself and navigate this?
The level of uncertainty really underscores needing a solid financial plan and good risk management, doesn't it?
Absolutely. And one recommendation we're seeing more often, highlighted in that MarketWatch article, experts now recommend a 12-month emergency fund.
12 months. That's a lot.
It is, but the thinking is, with economists at Moody's and Goldman Sachs seeing significant recession probabilities.
Amplified by trade uncertainty.
Exactly. Having a bigger cash reserve, maybe covering 12 months of essential living expenses, is becoming more prudent.
And planners like Michael Scarpati, Kat Irby-Arnold, Ramit Sethi are all saying, build up that safety net.
They are, emphasizing the wisdom of a larger buffer now. And the MarketWatch piece offered some concrete, maybe temporary ways to save quickly. Things like banking your tax refund, maybe finding a side hustle for extra income,
Sure.
making temporary but significant cuts to non-essentials like dining out, shopping, hobbies, trying to trim grocery bills.
What about retirement contributions?
Temporarily reducing 401k contributions, but only down to the level needed to get the full employer match. Don't leave free money on the table.
Okay, that makes sense. And selling unused stuff around the house.
Right. These aren't meant as forever changes, just focused, short-term efforts to build that crucial cushion.
Got it. And what about other assets? Gold came up earlier.
Yes, another asset class getting attention as a safe haven is gold. That MarketWatch article, gold is at a fresh record high. Does it still make sense to buy? Dives into this.
Gold has been hitting record highs, right?
It has, multiple times recently.
So is it too late to buy? According to the experts.
Well, John Schoyles from Goldcore, quoted in the article, argues it's not too late. She sees the surge above $3,000 not as the end of the rally, but as a significant flare signaling underlying issues and anxieties in the global economic system.
A flare. Interesting way to put it.
Yeah, she observes gold tends to rise when trust folds, when systems wobble, suggesting the turn environment is exactly when gold historically does well.
And Robert Minter from Aberdeen Investments called it the only currency that is not someone else's debt.
Right, reinforcing its unique characteristic, potentially attractive when faith in government currencies wavers.
And gold imports are exempt from Trump's tariffs.
They are, interestingly, as the article points out, which kind of acknowledges its unique role.
But it's not a get-rich-quick scheme.
Definitely not. Schoyles emphasizes it acts as a ballast for a diversified portfolio, helps preserve value, reduce volatility during turbulence elsewhere.
Ballast, not rocket fuel.
Exactly. Asset manager DWS even suggests a potential 5–10% allocation to alternatives like gold in a diversified strategy.
And the speed of gold's recent rise is significant. Schoyles called it not just a rally, this is a rupture.
Yeah, comparing it to previous milestone breaches that coincided with major global events, her final thought was really insightful.
What was that?
People are realizing that gold isn't for the end of the world. It's for the world we're in.
A potent reminder of its role in navigating current uncertainties.
Precisely. So bringing it all together for our listeners, what are the key takeaways today?
Okay, let's summarize.
We've seen significant market volatility, mostly driven by trade and tariff policies.
Right. Uncertainty persists despite some temporary tech relief.
Global markets reacted, but differently depending on direct U.S.-China exposure.
Expert analysts are cautious, downgrading U.S. stocks, warning about future earnings.
And importantly, we discussed practical steps, maybe building a larger emergency fund,
Up to 12 months.
and considering the role of safe havens like gold in a diversified portfolio.
So in these undeniably uncertain times, staying informed, staying prepared is really paramount, isn't it?
Absolutely critical.
Having a solid grasp of these dynamics, even when they're volatile, can empower you to make more informed decisions for your own finances.
Exactly. Understanding the risks and opportunities lets you navigate this with more confidence.
Well, that brings us to the end of our deep dive for today. We covered a lot of ground,
We certainly did.
but we hope this detailed discussion gave you a clearer picture of the key headlines and their potential implications.
Feel free was helpful.
We'll see you all tomorrow morning with new headlines from major financial magazines.